Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of GSK PLC, ticker symbol GSK. GSK, or GlaxoSmithKline as it was known until May of this year, is a vaccine and prescription drugs company. They have had a very rough 2022 so far, to say the least. Their stock price is down over 38%. Recently, they've been hit with this kind of 1-2 punch where they've spun off Haleon, which was part of GSK. Haleon is the world's biggest standalone consumer health business, with brands such as Sensodyne toothpaste and Advil painkillers. So Haleon now trades on the London Stock Exchange under ticker symbol HLN. GSK, meanwhile, is now focused solely on their vaccines and their prescription drug business. However, shortly after their Haleon spinoff, within the last week or two, there's been mounting uncertainty about their potential legal liability for Zantac, which was a heartburn drug that is said to have caused cancers. So there is mounting legal concern there that GSK is going to be on the hook for a large settlement. Right now, the potential for a settlement, if there would be one, is totally up in the air, so there's just a lot of uncertainty given that. At the time of recording today's video, GSK is trading for $34.06 per share. Year to date, as mentioned, their stock price is down 38%, which is just way below the overall market. Over the past year, their stock price is down 35%. Over 5 years, they're down 6.5% compounded annually. And here we really see the drop-off that they've had in the past couple of months. Over 10 years, their stock price has been cut by a third. They're down 4% compounded annually. And going back prior to the global financial crisis, GSK is also down about a third. Over the past 17.5 years, they're down 2% compounded annually. Keep in mind that this compounded annual stock return is not taking into account GSK's dividends. GSK is currently paying out more than a 7% dividend yield, which is very high, up there with some of the tobacco companies for being among the highest in established businesses in the entire market. So that's something that's also drawn a lot of people's attention, and that's something we're going to cover today as well. So as mentioned, GSK is trading just over their 52-week low, down more than 30% from their 52-week high. They are a large business. They have nearly a £57.5 billion market cap, which is about $68.5 billion US dollars. So for some more background about the business, in the pharmaceutical industry, GSK ranks as one of the largest firms by total sales. The company wields its might across several therapeutic classes, including respiratory, cancer, and antiviral, as well as vaccines. GSK uses joint ventures to gain additional scale in certain markets, such as HIV. GSK was founded all the way back in 1715 and is headquartered in Brentford, United Kingdom. So they are one of the oldest businesses that is publicly listed. We are going to be using the Select 6 for our fundamental analysis today. Based off 6 standards we should be looking at to come to a holistic and beginning understanding of a business based on their fundamentals. So let's get right into it. Starting off here, we want their average return on capital over the last 5 years to be above 14%. Over the long run, over the course of decades, a stock is going to return approximately what its underlying business is able to return, and the business returns are going to be captured here by return on capital. In addition to this, we want this to be above 14% because the average business earns about a 7% return on capital. So we can give ourselves some margin of safety in the overall quality of the business by asking that it be at least twice as good as average. While GSK's return on capital has come down over this time, over the last 3 years, it's been pretty steady in the mid-teens. And over this time frame, they're earning an average return on capital of 20.5% in a given year. So this is going to be our first check to start off. Next up, we're looking for earnings per share growth over the past 5 years. This will help us take into account both how their earnings have grown or not grown, as well as how they've either bought back shares or diluted shareholders. So over this time frame, they've more than tripled their earnings per share from 52 cents per share in 2017 up to about $1.50 per share in 2021. As an individual shareholder, this is a strong sign here. And for each share of GSK that a shareholder owns, they're now entitled to 3 times as many earnings as they were in 2017. So we're 2 for 2 so far. Then the next standard we're looking for is free cash flow growth per share over the last 5 years. Over an extended amount of time, for most businesses, earnings per share and free cash flows per share should be relatively about the same. Here we're getting a better picture of the company's financials in the fact that they probably had a charge against earnings in 2017, as their cash flows are up over this time frame, but not up as dramatically as their earnings made it seem. As an individual shareholder in 2017, you were entitled to $1.65. In 2021, each share of GSK now entitles shareholders to $1.96 of cash flow. So this is another check here. We're 3 for 3 so far to start off. Then for our fourth standard, we're looking for revenue growth, net income growth, and free cash flow growth over the last 5 years. This standard is going to be all or nothing, in that either all 3 of these metrics have grown and that's going to be a check, or if any of them are down, this is going to be an X. This helps give us the broadest level picture of the overall financial health of the company. And so while these metrics haven't traded exactly in like kind with each other, all 3 of them have been up. They've increased total revenues, they've increased net income, and they've increased their free cash flows from $7.2 billion in 2017 to $9.2 billion in 2021. So this is another check here. Of these metrics, free cash flow, which is here in green, is ultimately what we're going to care the most about. Free cash flow is cash from operations minus capital expenditures. It's the lifeblood of any business and can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. The value of a business is going to be the net present value of all the business's future cash flows based on assumptions for future growth and discounted back at an appropriate rate for that particular investment. Over this time frame, GSK has produced $44.3 billion of free cash flow, which means that in an average year, they're earning about $8.85 billion of free cash flow. So that is a lot of money, no matter which way you slice it. We're going to be using how much free cash flow they produce coming up here on our next couple of metrics. For our fifth metric, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be less than the amount of free cash flow that they produced over the past 5 years. This helps us evaluate how the business utilizes debt relative to their abilities to produce free cash flows. So it'll help us determine if the business is overly levered or not. At the end of last year, GSK had $26 billion in net debt, and over the last 5 years, they produced $44.3 billion of free cash flow. This one's going to be a check here on our fifth metric. GSK is not overly levered in the slightest, and in fact, they are continuing to decrease their debt. Keep in mind that with any sort of lawsuit, they potentially have a liability sitting here that's not reflected on their balance sheet quite yet, as they haven't put out any reserves for that. And again, all of that is up in the air, so you really want to dig in there and learn as much about that potential liability as you can. That's something that's just going to have to be done as part of your own homework. To recap quickly, we are 5 for 5 on the standard financial metrics. Let's see what our final checklist item holds for us today. Last but not least, checklist item number 6. We want them to have an average 5-year free cash flow yield of at least 5% compared to their total enterprise value. Total enterprise value takes into account both what the business market cap is as well as their net debt position. So this is a more realistic picture of the business, as if you would own the business privately. So currently, GSK has a $94 billion total enterprise value. As we learned, they produced $44.3 billion of free cash flow over the last 5 years. So in an average year, this comes out to $8.85 billion. And if we invert that number, $8.85 billion of free cash flow divided by $94 billion of total enterprise value is going to give us an average 5-year free cash flow yield of 9.4%. So this is almost double the metric we're looking for. This is a strong check here on number 6. Then lastly, as mentioned, GSK currently has above a 7% dividend yield. So they are paying out a very high dividend relative to pretty much any of their peers, and one of the highest dividends of any big established business in the overall stock market. So looking at their dividend profile here, people make mistakes all the time by blindly chasing dividend yield or a dividend track record. Here, what we're looking for is that their dividend is supported and sustained by their abilities to produce free cash flows, hopefully now and into the future. While their dividends per share have been flat over this time frame, they've actually been able to increase their cash flows per share, and they've supported their dividends with their cash flows in each of these 5 years. So this is a strong sign to see here. While this is a snapshot of the past and cannot give us an accurate prediction for the future, if they were able to continue these trends, it looks like they're going to continue to be able to give themselves some breathing room in terms of having a larger gap in the cash flows that they're able to bring in versus the dividends that they're paying out. A 7% dividend yield as it currently stands is very attractive, and so it would be unlikely that they would be forced to keep raising this dividend to attract new investors to the business. So at the same time, if they're able to use some of these other cash flows to keep improving their debt position, which is already phenomenal to start off with, and then to keep investing in the business where they're earning more than double the average return on capital, then this is a strong sign for GSK overall. Again, this is no prediction for the future, so you're going to have to do your own homework, especially with their recent spinoff from Helion and with some potential liability there to get a more accurate picture of the company going forward. Then last but not least, here we are using a discounted cash flow model to come to a potential fair value for GSK as a business. We are going to be using this model based off their historical growth numbers. So over the last 30 years, GSK has been able to grow their free cash flows at a rate of 3% each year. So if we include that over the next 20 years for both their growth and terminal stage with a growth rate of 3%, using the starting point of their free cash flows today, then we add in their tangible book value, we could reasonably expect that to earn an 8% return on the business. A fair value for the business is about $36.31. So currently they have a stock price of $34.06. So if you're satisfied with an 8% return on GSK, based on these historical growth assumptions, which you need to confirm or disconfirm one way or the other for yourself, then you could reasonably expect about an 8% return from GSK today. Keep in mind that this would be including their dividend payments, which make up 7.2% of this return. We would not be doubly counting dividends here. If instead, based on these historical numbers, you wanted a 10% return by investing into GSK, you'd be looking at a potential fair value for the business of about $30.90. You would have to wait for the business's current stock price to fall an additional 10% before you'd be able to reasonably expect a 10% return over the next 20 years from GSK. Again, these numbers are based off their historical growth numbers for the last 30 years. As most businesses get larger, it's more difficult for them to grow. While these numbers may not be accurate, it at least provides us a baseline for what we could reasonably expect as assumptions for GSK's future growth. This analysis and this discounted cash flow model are not meant to be financial advice in any way, shape, or form. It is not a buy or sell recommendation of any security. And before investing into any business, it's very important that you consult with the properly registered financial and legal professionals. These are historical numbers and historical assumptions for future growth. It's up to you to confirm one way or the other by doing your own homework whether these are accurate or not. So in summary, GSK using our Select 6 analysis checks the box on all 6 standards. They're earning about 3 times the average return on capital that a typical business earns. They've improved their earnings and free cash flow per share numbers. They've also grown revenues, earnings, and free cash flows all across the board over this time frame. The business is in a very healthy debt position currently. However, we are in the early innings of a potentially pending legal settlement for the business. So that is something that you're going to want to learn more about and follow closely, keeping tabs on it if you're interested in GSK. Also, relative to their total enterprise value, GSK is producing about a 9.5 average free cash flow yield, which is an above average yield and potentially gives a strong risk premium for the business. So that high free cash flow yield, coupled with the fact that the business is not diluting shareholders excessively, as seen in those per share metrics, and the fact that they're earning high returns on capital, puts GSK in a very interesting position for value investors who are wanting to learn more about the business. In addition to that, we saw that their current dividend yield of more than 7% is actually healthy and supported by their cash flow metrics. However, this is no guarantee that that would be the case in the future. And again, it's up to you as an individual to do more homework about it. And last but not least, through our discounted cash flow analysis, based on historical numbers for GSK, we found you could reasonably expect about an 8% return over the next 20 years from GSK today. And if you wanted to wait for a 10% return, again, using those historical assumptions, which you need to validate for yourself, you'd have to wait for the business to drop down to just under $31 per share. So you'd have to wait for the business to come down about 10% from where it's currently at for a 10% return over the next 20 years. Again, all of this is not financial advice. It is not a buy or sell recommendation of any security. It's both important to validate those assumptions, as well as it's extremely important that you consult with the properly licensed financial and legal professionals when considering any investment. So with that said, that's it for today's fundamental stock analysis of GSK PLC, ticker symbol GSK. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about GSK with me, and have a great day.